Foremost means more. More training, more information, more ways to grow your business. Find out what Foremost can mean for you at foremostagent.com. Click on Foremost Means More.
Carrier executives were releasing bullish reports about commercial insurance pricing in the days leading up to this year's PLUS D&O Symposium, where Stephen Anderson, an executive vice president for broker Beecher Carlson, and Mark Herman, the president of CNA Specialty Unit, said D&O prices are rising as well. Hear them discuss in this interview with Carrier Managements Susanne Sclafane.
It's clearly starting to impact the D&O world. The market for D&O is not completely homogeneous, so you have different sized companies. Some are public, some are private. You have not-for-profit companies, so you have to look at it broken up into those aspects. For privately held and not-for-profit companies, due to the breadth of the coverage and full entity coverage for the form, we are seeing in most situations a low double-digit increase in rates on a year-over-year basis, all other things being equal. And there's enough anecdotal evidence out there that some of the rate increases are significantly greater than that in the event that a company has had some issues with claims during the previous policy period. For publicly traded companies and larger companies in general, the rate increases are more modest, and in fact, there are a number of situations where the primary D&O insurer may obtain a rate increase mid-single digits to high single digits, but because of the amount of capacity available in the marketplace and the law of supply and demand, the excess rates may be flat or marginally down, so there's a bit of an offsetting impact. So the renewal rates overall can be anywhere from flat to up mid to high single digits for a larger publicly traded company. In the privately held portion of the D&O market, there is an acceleration of the rate increases, and I think there are two factors driving that. One is underwriters would argue that business historically has been underpriced relative to the breadth of the coverage. The other issue, frankly, that's driving the rate increases is that for a lot of privately held companies, they may only buy a primary layer of insurance. So in effect, you don't have this two-tiered market where you have a lot of excess carriers who can, flatten the rate or provide marginal decreases. All of the primary insurers are being, affected. It's sort of, death by a thousand cuts. You get small claims across the board, and you're paying a lot of little claims. So since most of the insurers in the privately held space are similarly situated as primary insurers, you're seeing more consistent behavior in terms of rate increases. And so it's more difficult to create competition to mitigate those increases. That's not true in the public sector.
Public side, we're beginning to see rates up to 10% on the primary. Maybe on the first excesses above that. It could be higher than that depending on how troubled a business is. When you get to the higher excesses, we're starting to see some increases on that, but it's nowhere near as much as what we're seeing on the primaries and the first excesses. Because of the emergence of the claims over the last couple of years have really more targeted the primaries and the first excesses, so the costs attributed to those claims have really hit that particular section of the business. There's not as much competition, frankly, in the primary sector either, so there's just a little bit more pressure on those particular areas for those reasons. There's obviously the financial crisis that really hit 2007, 2008, 2009. There were some issues that emerged from that. It's not clear that that's ended completely. I mean, I think it's been arrested in the short run, but in the long run, it's really hard to tell where that's going to go. So we're very cautious and keeping close watch on that.
Like Anderson, Herman said privately held companies are seeing greater increases in D&O rates than public companies, but he doesn't foresee any near-term moves by carriers to pull back on the broad coverage grants for private companies.
Some of the things we've seen would justify the reduction of coverage out there. I think it's probably too early to tell whether that will happen or not. It's still a highly competitive environment, and if you came out and led with something like that, it's clear that you wouldn't be able to retain a lot of business. So we're trying to watch it, look at it individually, try to underwrite it individually, account by account. But certainly those are issues that I think the industry is going to watch and determine whether they're going to make adjustments to that or not. Historically, the specialty lines have been profitable, and that's why there've been, when I was in the business in the early days, there was just a handful, and obviously now there's dozens, if not more than that. So really, there's been this embedded profitability that sort of has been in the specialty arena that wasn't necessarily true in the commercial sector. That's changed. It's much more, as we're talking about, competitive now. It's driven the margins way down, and you have to be more shrewd in how you manage your book of business. You have to diversify it much more than you ever had to in the past, and you have to be more thoughtful about how you approach that particular business. So it's not what it used to be, and so you have to watch it and manage it much more diligently. Where's the next one going to emerge? You always know that the FI is a tough one. It's a concentrated area. Usually if it hits there, it hits systemically, so you really have to be very cautious in that arena. It's not a bad place to do business, and you can diversify within the class. It's just that it's perilous when an event occurs, such as happened in 2008. It's watching the FI industry, it's watching the tech industry, it's watching the healthcare, medical industry with all the changes that are going on there. It's really trying to not overexpose yourself to any one category, any one class, and try to underwrite the best in class so that you can have a profitable book of business and be diversified in your spread of your portfolio. And that's a hard thing to do. But we work very hard to try to manage that on an ongoing basis. So I worry about everything. We look at everything that we possibly can, but by definition, the way that this stuff plays out, by the time you figure out it's a problem, it's already too late. So you really have to manage it on a continuous basis.
Here, Herman summed up the key challenge for senior officers of specialty insurance companies in one word.
It's rate. I mean, if I look at it, I think it's rate. There's been a steady decline since the early 2000s. There's been an inflationary effect that's really occurred absent really sort of, some of the spikes that we've seen in litigation. So really just on a normalized basis, you're going to see that that's gone up, rates have come down. And so we're not sufficient as it relates to the rate environment. Expenses, because obviously if we don't have the revenue coming in, it's hard to offset that, so we have to manage the expenses. And the thing that companies probably do or don't talk about, but it's very difficult investment return environment. So obviously it's hard to keep up just with inflation, given the 2 to 3% you can earn on a risk-free basis. So, given those constraints, it's important that we go out and we get the rate, in addition to doing the blocking and tackling on the underwriting that's always critical and always important.